Welcome to the Business Briefcase podcast, brought to you by loandesk.com.au. This is number 3 in the series. I'm Lee, and I'm here with
Simon. Good morning, Lee.
There he is. So today we're going to be talking about invoice factoring or debtor finance, and sometimes referred to as invoice discounting. This is the third podcast in the series. We skipped over, it was supposed to be the second one, but we did want to touch a bit more on what that unsecured lending topics were around the pricing. But today we're moving back onto quite a heavy topic, one that we're going to spread over 2 podcasts because it's quite an in-depth topic, and there's a little bit to learn because there is a few variations to the way that these financiers operate in Australia and the different types of facilities that you can get. So, look, basically, we're going to strip back right now what the basics are of invoice factoring. Just get somewhat, you've been doing this for a little while now. What's your basic concept there?
Yeah, all right. So, for me, and I'm no expert, but if I have something called an invoice, which essentially is a piece of paper, I know that I can use that as something which a lender will use as security and lend me money against, basically. So in a lender's eyes, that has some value, and I know that I can actually sell that to a third party and realise some cash now. Yeah, that's how I see it.
Yeah, you're exactly right. I mean, I guess from a really an outsider's point of view, it's quite a simple process, isn't it? I mean, you can dress it up, you can dress it down, you can do whichever way you want, but the reality is it's based on a few key components, and those key components, is really, it's an invoice for finished product or a service that's been performed, isn't it? I mean, and can you prove that work's been done, really, isn't it? So, I mean, key components are that you can demonstrate you sell on credit terms, you produce invoices. With that invoice, you deliver a product, you get a proof of delivery and or a service, and you can show that service is done or completed. Now, once that's done, you then have a viable asset that you can borrow, or really, in the case of a factoring, which we'll go into in a second, but you're selling that asset for a certain value to obtain cash up front today.
So that's where it gets a bit sort of hazy for me. So I'm actually selling the invoice to a third party. Is that what's actually happening there, or is a lender just lending against it?
Yeah, so look, in the legal sense, you truly are technically selling that invoice. Yeah. But, I mean, in the practical sense, you're assigning the invoice, and the legal term is assignment, but the reality is you are physically selling that asset, but for its value today, in return for cash today for a value. But in the actual, I guess the real world today, we're just assigning those invoices to the financier on an ongoing basis. And this dates back, and something which people might not realise, that this is an extremely, extremely ancient form of financing. Before even banks came along and offered overdrafts or any other type of these fancy financing words like lines of credit, factoring was basically, my understanding is a 4,000-year-old type of financing, which dates back to, now forgive me if I get the pronunciation wrong. It's Mesopotamia Culture, and that was back when they all believed in multiple gods, and they believed in demons, and that the demons and the gods would rain down disasters. And it's hopefully not that like that today. Some things
don't change, do they?
Things have changed. But it was typically, today, invoice finance is used on a domestic level between businesses, but it traditionally was born from merchants that were dealing internationally. So someone would send their rice or their flour to another country, and by the time it took to get to that other country, the person that originally sent it, there would be a person or a bunch of people that would say, look, you've just sent the stock to the other country, I'm going to give you some money for it now, and wait, once that ship hits the other side, then they'll pay and I'll collect the money later.
Right.
Just a bit of a brief history there.
So we got this thing that's been around for a long time. Essentially, you sell the invoice and you can realise some cash now, and that's going to assist with your working capital, because like most businesses, they probably have a lag between the time which they need to pay their suppliers and the moment which their customers pay them, right? Yeah. So I get that. Just going to bring this forward, really, to maybe a more real level. So I actually had a chat with my mother about this very topic. I know, which sounds strange, but we were chatting about the invoice financing, I guess, product. And the very first thing that she said, and this is, I guess, her perception, but that's often the most important thing, was that's the sort of finance used by companies which are on their last legs. And that is a quote from her. Now, do you think that is warranted? Where do you think that came from? And is that view still hold true now?
Yeah, it's a very, very interesting topic of discussion, I guess, still today, and definitely amongst accountants, especially. And it really is always said, this is the funding of last resort. That's what you always hear. You have to factor. Oh, great! There's something the business is going under, and this is the last thing you use, right, over any other type of financing. Definitely the perception that's been out there, it's something that the industry's been trying to get over for a long, long time, is, lender of last resort. It's definitely not reigning true anymore. Really, I mean, going back to what you're saying is, I think you're saying, where does this come from? Where does this perception come from? Well,
that's right.
There's an easy answer for that. I mean, back in the 60s and 70s, it all came from, a drive in the Australian... when factoring started to really get a bit of traction, they were charging rates like 20% on an invoice. So someone would turn up at your doorstep and literally say, hey, you got a bunch of invoices, I'll buy them off you today, and I'll buy them off you for 80% of its value today, and you'd lose 20%, and you'd think, you know what, I'm only going to do that when I'm in serious, need of cash. It's not an ongoing solution for me because my profit margins might only be 20%, but I just need to...
And that's expensive if you're selling that asset, or you're selling that future payment for 20% of its value, basically, but that's money which you would have got back in maybe 4 weeks' time, you know what I mean? So if you think about the annualized rate, that's, that's pretty high.
Yeah, the APR is pretty decent on that one.
So this was the practice that you're saying was more common several decades ago, right?
That's right. Yeah,
okay.
Yeah. Throughout the 70s, probably, I think it hasn't gained real great traction until the last 5 years. It's really started to really hit its straps. At the back of the GFC, when that started to roll off, that's when we saw a big uptake of financing, because people were just turning to any other type of funder that could fund them on an ongoing basis, kind of like a bank would, but without the security in place, which, that's something that we'll touch on. But today, going back to it, yes, it was perception. It's something we're trying to get over in the industry, but it's moving away from that now it's becoming a bit more mainstream. I mean, you've got one of the largest factoring or invoice discounting companies is, it's growing exponentially. And not only that, the banks are starting to back them with large facilities. I mean, I won't name names, but I think one of them just got a $500 million line of credit from the bank to inject working capital. So just going back to recap, look, the perception's not warranted. Things have changed, it's evolved, it's moved on. It's a different market today than it was a few decades ago, and it's definitely a mainstream product, which brings me to, I guess, the three main typical types of facilities that exist today in Australia and how they're used. The first one, and Simon, you probably want to interject here at any point, and what your thoughts are, but number one on the list, which is still probably exists today, that replicates the oldest form, is called spot invoice factoring, and it is, from our point of view, it is typically how it sounds. It's on the spot. So if you've got a bunch of invoices, there's financiers out there that you can go to, give them a call. Within a few days, you'll have funding against those invoices. You'll be able to get access to cash for money that you're waiting to be paid from your customers.
Right, spot factoring. So really what you're saying is that there's flexibility in that I don't have to finance my entire ledger. I have the ability to pick and choose which invoices I'd like to sell to a financier. And so I'm thinking about it a bit further. To me, it sounds like that's going to be very beneficial for a business maybe in the early stage of their progress, where they might like to they might have obtained a single order which is relatively large, I guess. They've managed to fulfill that. They then like to realize that cash earlier, basically, so they can fund the continued growth of their business. So I'm thinking early stage businesses, this would be very suitable to.
Yeah, that's definitely one area that you'd be looking to. Oh, well, it definitely benefits that area because, I mean, when you've got no trading history, but you've got, solid orders, or, you're dealing with good quality customers, going to another type of financier that wants to see some trading history, going to a financier that wants to see up-to-date financials, it's just not going to cut it. And a spot factoring facility is probably going to be your best bet. Now, that's not to say it's not just for businesses starting out. I mean, businesses we see are using it at any life cycle that they're going through. It purely would just generally come down to that you need periodic injections of cash flow, and you need it done in a flexible way that's not tying you into any type of contracts or ongoing fees. It's a spot facility, one off. You pay for it as you use it.
Right. I'm guessing as well that once someone uses this type of facility, if they have a business which is growing, then I'm guessing it's going to be very likely they'd like to probably move to a different type of facility where they would like some reoccurring type financing, or it's just going to be easier to fund more than one invoice.
Yeah, so that moves us on to, this is the most popular type of facility that you would get. And it's split between, it is an invoice factoring facility, but in Australia it is more commonly marketed by the larger companies as a debtor finance facility. Debtor finance is split between what we call a partial ledger facility or partnership facility and an all of turnover facility. It is how it sounds. Partial mean that they will finance a portion of your financing ledger or your debtor's ledger, and all of turnover is, of course, how it sounds. They're going to basically put you into a contract where you're financing all of your invoices on an ongoing basis, and it's just meant to be more of a, become part of your business where it's just an everyday occurrence, whereas the partial facilities have a lot of the same, characteristics of a full ledger facility, but that extra flexibility where, you might say, look, I'm turning over $300,000 per month. However, I don't need access to that much money, but I do need ongoing access to about $100,000 a month ongoing. So that can benefit.
You mentioned the word contract there. So to me, this sort of feels like, just put this in, a very simplistic terms, this sort of feels like a phone contract where you might sign up for 12 months essentially, and you might get a slightly better rate. Whereas compared to what we were just speaking about with the spot factoring, that's sort of like prepaid almost, isn't it? Where you're sort of free to pick and choose and to leave when you want. Is that sort of what you're saying there?
So just going back to 1 and 2, spot factoring, debtor finance, partial full ledgers, the spot factoring is number 1 on the list for flexibility, right? It purely is, you've got an invoice, you finance it. Number 2 on the list is the partial ledger facilities. Now, the contracts, the way they work in Australia right now is you pay an annualised minimum fee for use of that facility, and that's based on your turnover or the amount of money that you need access to. The financier will make available that kind of money for you on an ongoing basis, but you will pay a minimum fee over 12 months. Then, not going too deep into how they price just yet, which will be in the second podcast, but they will then charge you what's called a discount rate, which is effectively the interest component on your invoices. So every invoice that you submit for funding, there will be a administration fee plus a discount fee per day until that invoice is paid. Now, the administration fee that you get charged on every invoice goes towards making up that minimum contract fee. And that goes back to what you just said. I mean, that's how you think about it. Well, I've got a mobile phone contract. I've got to make up $1,000 this year. If I don't, then I'm going to have to pay for it anyway, right?
Exactly.
So the way that the financiers do it is they will say, okay, well, you've said that you're gonna finance $1 million this year with us. Well, we expect you to make up that minimum fee that we determine. Now, it depends on the financier that we're talking about, but we can go into depth on that in the next one.
Yeah, right. So if I don't use my monthly calls, I lose out basically.
That's right.
Okay,
yeah,
makes
yeah.
sense.
So, yeah, I mean, there is some hidden benefits that some financiers forget to market, and spot factoring is great and flexible, but when you move into the realm of these ongoing debtor finance, partial ledger stuff, there's these hidden benefits where they will monitor your debtors ongoing. They'll monitor the credit of your debtor. So it's kind of like you get debtor management. They look after the ledger for you. In some respects, they clean up your ledger for you, so you might not have been that great at keeping a handle on your invoicing, but now you've got this other third party that's starting to assist you and give you help with assessing credit. They forget that, if you're going to deal with a new customer, and that customer says, hey, I want to deal only on credit terms, and you're thinking, oh, geez, should I really sell to this guy and send him the goods now and expect credit? How do I check out if he's any good? Well, once you put these facilities in place, you can then go to the debtor financier, submit them for funding. They'll either approve them or not and say they're creditworthy, and then I can finance that invoice. So offering credit terms to this new customer will, I'll be able to finance an invoice today and get paid instead of demanding payment up front.
See, that doesn't sound very much like a traditional bank loan at all, does it? Because that sounds very much like someone who is lending you money is then getting involved in your back office type processes, right? Sounds very much like a partnership to me, right?
Yeah.
So, whereas a bank loan, in the traditional sense, you get some money and then you don't hear from your bank unless you do something bad or if you'd like to change and go somewhere else, basically. With this type of facility, very much so, you start the engagement, and then they're involved basically with I guess your customer relationship management going forward in some respect. Is that fair call?
Yeah, I guess it is fair. I guess that goes back to a bit of the perception. De factors or invoice financiers or debtor financiers, do they disrupt your business? Is that what they're doing? I mean,
because if I'm running a business, I'd not like a third party stepping in between me and my customer. And if they're going to do it, I'd want it to be done lightly, or I'd want them to tread carefully.
Yeah, and that's definitely right, and that's why the perception needs to be washed away a bit. I mean, at the end of the day, they're a finance company. It is a partnership. They don't really want to be getting too involved in your business. I mean, think about it. If they've got 100 clients, they don't have the resources to be stepping in and getting too involved. They really are just financing your invoices at the end of the day. You submit them for funding, you get your money in the bank. Yes, they do a lot of credit checking and debtor monitoring. So they actually put in what's called, credit alerts or, VADA alerts, where they might get, alerted if your debtor all of a sudden gets, a ding against their name on their credit file, and they might contact you and say, hey, did you know that your customer is becoming a bad credit now? You might want to hold off sending that new order to them. That's pretty much as far as it goes in terms of getting too involved. You're probably going to talk about their collections.
Not really. I think probably just the most important question in my mind is that if I start one of these type of facilities, so if it's a spot factoring or if it's a partial ledger facility, which you've just spoken about, what will my customer see? So what's the change that my customer may see as soon as I start one of these? And I think that's the most important thing. And I think personally I'd like to see that to be ideally nothing at all. And if it's got to be something, I want to know exactly what that is.
Yeah, so to make things even more complex in terms of the type of facilities that are available, there is what's called a confidential facility available in the market. A lot harder to get approved for. You've got to jump through a lot more hoops. You probably need to have some kind of asset backing.
So confidential as in it's like a secret and your customers just won't know.
Kind of like a secret, but kind of not. I mean, I think your customers aren't that silly. At some stage they're going to figure out that there's a financier somewhere in there. Okay. But the reality is the technical aspect of whether it is disclosed or non-disclosed, which is confidential or not confidential, is that the financier in a disclosed basis will put a notice, what's called a notice of assignment, on your invoice. Now,
right. That's
right. So there's actually a blaring notice on the bottom, blaring in terms of you can read it. It's visible. It'll say this invoice has been assigned to a financier, and you are now directed to pay as per directions below. Now, that's actually coming back to one of the technical aspects of how a facility works. When a financier finances invoices for you on an ongoing basis or a spot factoring basis, they've given you the money up front for that invoice. And the way that they get paid back and the way that they're able to finance you so easily and readily is because you will be directed to have your customer pay that invoice in full back into the financier's account. And that comes back to the notice on the invoice.
So there's the impact. So the impact is essentially I've got a third party being, advertised, for want of a better word, on my invoice. And it sounds like the money is no longer going... it's no longer going from the customer to me. It's going via a third party.
That's right.
So there's the impact, right?
Yeah, so that's part of the risk element that the financier tries to cut off, because if you think about it, you've submitted your invoice, you've got the money up front now, and the money's just coming back in to repay what they originally gave you. Then they debit, their fee or whatever it is, and give you back the balance. So we didn't touch on this either, but a typical advance rate from pretty much every financier in Australia is an 80%. I've got $100 invoice, I submit it to the financier, I get $80 or up to $80 today. And then when that invoice is paid, they take back the $80 plus their fee and refund you the balance, which they refer to as either the reserve amount or a rebate amount. So yeah, look, basically, I guess disclosure is in that sense. They will know that they're financing. Moving on to undisclosed or confidential. Really, I mean, the most confidential you're going to get today is there's just no notice on the invoice. Most financiers typically will still require you to change the banking details, but it'll be a bank account set up in your name, your company name, but it's not your bank account, right? It's the financier's bank account. It just means that every time your invoices go out, there's no assignment on that notice or notice on that invoice to say, hey, I'm financing my invoices now, pay into a new account. Your customers will just get a light touch from you or the business owner saying, hey, I've changed my bank account details, and
I see.
That's how it works.
Yeah, so that option seems slightly better to me, as I probably would rather not a third party's logo being on my invoice. Again, it's my invoice, it's sort of my business. But it sounds like there's no way to get around the fact that you are losing control of that cash flow. It is going to a third party first, and then it's subsequently coming through to you.
Yep. But which is cash flow, which is not yours anyway.
That's right, because you've sold the invoice. That's right.
You've already received the money up front for it. So the financier... And confidential and non-confidential, it's a nice to have confidential, but the reality is, going back to what I was saying, you got to jump through quite a number of hoops. I mean, you've got to prove a couple of things. You've got to prove you're a pretty substantial company. You've got certain processes in place. You've got a back office staff that handle constant collections. You've got your collections under control. You can handle it. Not only that, they want to see proper financials up to date, no tax debts, no dings, no credit problems. You're a clean company, profitably trading, and you might have some security as well. So they want their bag and eat it. So
and by security, you mean what?
Property security.
Property security.
That's what you're looking at. Okay. Property security. Second, you can definitely get them, second mortgage security or whatnot. So that's getting a confidential, which is a nice to have. If we can get them, we want them. But if you want access to lots more money that goes outside of the realms of your asset base, then you're going to go full disclosed or non-confidential type facilities, which are the most common practice going around.
Okay.
Yep.
What was the third type?
So the third type is something that most of us SMEs, unfortunately, aren't going to get access to. It's usually reserved for large turnover businesses. That's called invoice discounting. That term usually, it's thrown around a lot. It's generally reserved for businesses turning over in excess of $5 to $10 million a year. The term originated from the UK, brought to Australia. Some of them, some of the financiers in Australia use it, some don't. Generally, it's reserved for banking type facilities as a term, in some of the top 3 non-bank financiers here in Australia. The difference between an invoice discounting facility and a debtor finance facility, technically, when you engage a debtor financier or a factor, invoice factor, it's the purchase and sale of an invoice or an asset, right? So you're actually physically, legally selling that invoice. When you engage an invoice discounter or a banking type facility, it's an assignment of the invoice ledger. So what you're doing is borrowing against your ongoing invoices. It sounds the same, doesn't it? But technically, it's not.
Yeah, I don't really get it. It sounds the same to me.
It does sound the same. So an invoice, when you borrow money, it's a different aspect where a financier doesn't have an equitable right to recover against those invoices directly, but has the right to, I guess, appoint a third party, generally to your company, and recover those invoices. But it's more of a borrowing line. So you're borrowing the money. It's it's not a purchase or sale of an asset where it goes onto your balance sheet, and it's more of a banking term. So it goes into their serviceability and all sorts of things. Whereas a factoring facility is a straight out purchase and sale of an asset. So technically, in a factoring sense, that financier now owns those invoices individually. Each one of them is now sold. That's an asset that's been sold.
And in a situation where an invoice wouldn't get paid, it sounds like if it is a more traditional factoring type facility, the financier would be within their right to contact your customer.
Correct.
And look to seek the funds through that avenue. Whereas what you're saying is with the invoice discounting facility, the financier wouldn't have the right to speak to your customer or to, I guess, try and get involved in that respect. They would have to seek funds through yourself as the client of that financier.
Yeah, because it's like borrowing against the company. So you've borrowed the money from the financier under an invoice discounting facility, and the financier would enforce or try to recover that money just like a normal loan would. Whereas a factoring facility, this is where they cut off a bit of their risk, is that if they can't get the money out of you, they legally have the right to go directly to that customer and say, we own that invoice, we're going to recover against it. You still got to pay that invoice to us. Which
obviously is not something which a business owner would ever want. You would never really want a third party sort of getting involved and speaking with your customers with that sort of issue, right? So I guess that's even sort of greater reason to make sure it never gets to that point, really. Yeah,
that's right. And when you engage these types of facilities, you want to be making sure that you're financing your good paying customers. I remember years ago I used to go see people and they'd say, "Oh, look, I've got these bad paying customers. Can I finance them?" And you say, "Well, why finance your bad customers? In 30 days' time, they're going to be in a worse position because they're not going to end up paying the invoice. You're going to end up paying that money back to the financier anyway."
That's right.
So, don't do that.
It's bad for everyone.
That's right.
Yeah.
So you want to be financing your good paying customers, the ones that pay on time, the ones that pay readily and they got good credit, because at the end of the day, that's going to cost you less money, less grief and angst, and the financier is going to say, well, you're a great client because you understand that we've got risks. We're basing our financing completely off those invoices are the financier's only security. They don't have property, they don't have all this fancy stuff that banks might want to grab off you. The invoices are their value, so they want to work with you and say, look, there's a bit of a trust relationship going on here, give us your good paying customers and this will run like smooth as a daisy. No, that doesn't make sense, but
doesn't sound very smooth.
That's a bit lumpy, a bit scratchy around the edges. But look, these facilities, once you get into them and you understand them, you think, oh, it's such a disruption at the start. Then you start to get used to the process. And, instead of fighting financiers and saying, oh, why do you want all this paperwork from me? Just get it in place, give it to the financier, and things will run really smoothly. Yeah.
It kind of feels like, and I'm not sure if this was your intention, but if you think of, I guess, the growth cycle of a startup to them becoming much larger, they would probably follow the process that you just went through. So they start off and they make a few sales, they have some invoices, maybe just a couple of them, they go to a spot factor and they realise some cash that way. After a while, they have some more of repeat sales or some less lumpy cash flow, and they might graduate to a partial a partial ledger facility.
Yeah, partnership or partial, yeah.
So they've graduated to, I guess, a facility where they're able to realise some additional cash flow. And then after a while, after they grow their revenue, maybe their back office processes are a bit more tight, so to speak, and they might graduate to a facility which is offered by a bank, but still essentially a loan against the cash flow or the receivables in their business.
Yeah, that's right.
Okay.
We're going to push on because we don't want to drag this out because it's quite a large one. We'll split it up into 2 podcasts. We'll just quickly touch on a few benefits, which I think you've probably already ascertained by what we're talking about. But key things are factoring in pretty much 90% of the time, there is no property security required. That's a pretty key thing, right? So it's not tied to the asset value or your equity left in your property. So you go to a bank, you get an overdraft, you got 100 grand's worth of equity. The bank says, great, we'll give you 100 grand credit line. When you use that up, what happens?
So what if you're growing and that lasts you 6 months?
Yep.
And you need to obviously feed a growing business. So now what?
Yeah, so now what? You go, what's my option? So then you go to an invoice factoring and company, and all of a sudden you start hearing things like it's a line of credit tied to your sales. It grows with your company. It's not tied to your assets. As long as you're doing business with credit-worthy customers and you're invoicing regularly and things are getting paid back and you're going into a bit of a trust relationship and you're giving us good paying customers, it'll grow as you grow. They don't turn around and go, hey, by the way, you've run out of equity in your property. So that's a really, I guess, a beneficial thing. I mean, there's other things that you'll hear from the sales guys that will come in and say, you can offset the cost by paying your suppliers up front and getting a discount. I mean, some people can do that, but is it utilised very often? Probably not. You think about it once and then you get into the facility and you probably never do that anyway. But if you do, good on you. Look, I think going back to how do you qualify, that's once again, we've talked about that, good quality customers. Financiers, and we'll go into this in the next podcast a bit more, but just touch on it, they look for what's called a spread of debtors or a spread of risk, essentially, isn't it? Their concentration of risk. So I'm just interject here, a very risky customer or client is someone that typically has how many customers?
Well, one maybe.
Yeah, that's
that to me sounds like putting your eggs in one basket.
That's right. So I mean, exactly right. I mean, I think if any business, that's a lesson. I mean, if you can spread your risk across a lot of customers, if one goes down, your business is still surviving tomorrow to keep trading and generating sales.
So what you're saying is, again, going back to your earlier examples, the person who's with a spot facility might have one invoice or one customer is probably going to pay a higher rate than the client who has a ledger of clients basically and sells multiple invoices across multiple customers to a financier.
Yeah, so if you can think about it, the financier thinks it's like as if they're in business like a normal business. They'll be like, well, if you've got a spread of customers, if one of your customers doesn't get paid in and we're financing you, then that's okay because we can keep this facility going very easily because, one falls over. It doesn't matter. We replace it with another financier. You can pay it off with other cash flow coming in. It's not an issue. Whereas if you've just got one customer, and don't get me wrong, the spot factors will do it. They will finance you and you pay for that privilege. But these guys that are charging you great rates, and it's like anything, it's an assessment of risk. But if you've got one customer, a lot of these bulk guys and these partial ledger guys, they're just looking at it and saying, well, if I give you $100,000 and this one customer goes over, you don't have any property assets. You can't expect, and you can bang your head on the wall you want. They're just going to say, well, it's just too risky for us. And you should be thinking the same thing. And it's not usually until you go through a school of hard knocks and a customer goes down, and it typically happens to guys unfortunately in the construction game, and I've spoken about guys in construction again, but it's a hot area. It's a hot industry that, financiers look at, and they do think long and hard sometimes before they do finance you, unless you've got a good spread of customers. So industries, just quickly, I think we're running out of time here, but construction's the main one. Financiers, and Simon, you've seen this with people coming through Loandesk. I mean, it's people who are invoicing on a progressive basis. So you're in construction, you've got progress claims, you've got an overhanging contract that's got liquidated damages in it, and invoices are subject to set off. There's certain legalities and technical.
Yeah, you've mentioned several words there that I don't really get, but it sounds like effectively or really that if a financier buys an invoice worth a certain number of dollars, there's an overarching contract or rule which says, under certain situations that customer does not have to pay that, which is obviously a bad situation for a financier who's paid for that invoice if that's not going to get paid back in the future.
Yep. Because
there is some overarching rule which says, hey, you don't have to. That's risky, isn't it?
It's risky. Yeah, you're on point. Definitely on point. But once again, there's financiers out there that will finance you.
Yeah.
You can get it. We've got lenders on board here.
We've seen
it. And it comes through, and the other guys say, look, progress. We go, great. That's more suited to a specialist factoring company that only does construction industries.
And what we do see is that where you would typically get an advance rate of up to 80% for a non-construction based industry, we sometimes see that advance rate gets dropped.
Yeah.
Right. So you might get 60, you might get 50.
Yep.
I guess that's one way which these financiers try and mitigate their risk.
Yeah, that's right. Look, we're going to wrap it up here. We'll finish up this podcast because there's actually quite a few more topics that are really interesting that we want to go over. That'll be in podcast number 2. Basically, we didn't touch on, really what do the lenders want to see? Do they really care about your financial history? And really, what are they mainly interested in? You submit all this financial information to them, but what are they really looking at? Simon, I'm sure you agree on that. The next podcast coming up is the number 2 in the factoring series, the Business Briefcase podcast at loandesk.com.au. We're going to talk about and delve really deep into what do these facilities really cost, how their pricing works. We touched on it, but what are the real costs and how do they compare between the 3 types? We'll go through the nuts and bolts of what we mentioned: concentration, dilution, advance rates. We'll discuss what lenders consider fraud, which you might not consider fraud. You'll think, hey, I'm doing everything fine, it's my money. We'll go over that. We'll talk about how the lenders will recover from defaulting clients. So make no mistake, you need to listen to exactly what will happen to you if you get yourself into a position of getting into trouble with these types of lenders. All that good stuff that you probably won't see in the flashy marketing brochures from the factoring companies throughout Australia.
This is going to be fun. Can't wait.
Thanks, Simon. Thanks for listening.